is keeping the official cash rate unchanged at 8.25%. The global economy has been experiencing some changes over this period, significant rises in oil prices and food prices, and at the same time we've seen activity weakening in many economies due to the global credit crisis and due to slowing housing markets. In New Zealand, these factors have been coming together to present something of a challenging environment where we now see weaker economic activity and higher inflation short term. The bank is now projecting annual consumer price index to peak at 4.7% in September this year. This reflects higher food and energy prices, but there is also some persistent underlying inflation still in the system. Despite this, we still do expect to see inflation come comfortably inside our target band over the medium term. That's based on expectations that commodity prices stop their rise, that inflation expectations remain anchored in New Zealand, and that our weakening economy does help contain domestic inflation. Compared to our March monetary policy statement, our economic outlook is now weaker. We are forecasting little GDP growth over this year and only modest recovery next year. This is principally reflecting a weaker household sector, which in turn is driven off a softer housing market than we had been forecasting. In addition, there's some effects from a more negative terms of trade picture. We note that government spending and recently announced tax cuts do help to offset this lower growth profile, but they do also add to short-term inflation pressures. We will remain focused on medium-term inflation at the Reserve Bank. That's consistent with our duties under the Policy Targets Agreement. Provided the economy in New Zealand does evolve in line with our projections, we now feel that we're likely to be in a position where we could lower the official cash rate later this year, and that's sooner than we previously envisaged. Thank you, ladies and gentlemen. That's the end of the formal statement. Happy to take any questions here. To help is Dr John McDermott, the Assistant Governor and Chief Economist, and Tim Hampton, Head of our forecasting. Any questions?
Dr Bollard, this is a pretty bleak outlook for households. You've got almost no growth in household spending. You've got a 22% fall in real house prices and inflation getting worse before it gets better. Aren't people entitled to think that you should have cut rates by now?
Well, we haven't cut rates by now because we've been concerned about domestic inflation, and that's been there in the system and it's still there. So we're looking for signs of that coming off before we cut. So no, I think we've done precisely the right thing. We have been one of the central banks that's run a tightish monetary policy, not very tightish around the world. A number of others are now finding they have to scramble to catch up around the world. We think we've probably been running monetary policy at the right time in the cycle.
The statement says that interest rates may need to remain well above neutral for some time. What would be a neutral rate?
I don't think we've been trying to talk precise about that, but somewhere south of
To predict little GDP growth, is there a possibility of a technical recession?
On our numbers, we don't have a recession, but certainly we couldn't discount the possibility of a technical recession during 2009.
Is this a scenario that's what economists call stagflation?
No, I don't think so. I think stagflation relates to a longer lasting period. We're talking about a year of very low growth and a short-term inflation peak. We do see inflation coming off, we do see growth eventually picking up again. We think, despite the fact we're getting price pressures somewhat like the 1970s, we think the New Zealand economy and indeed OECD economies are far more flexible and better managed now, and that therefore we do avoid stagflation.
Did the markets overreact to the tax cuts announced in the budget?
We wouldn't particularly comment on that. We've been more concerned about how we see them. For us, we've had, I guess, roughly half of that already factored in and had for the last year. The further amount, as I said, does add to inflationary pressure, but it actually does help improve that softer economy roughly the time when the economy troughs.
Would bigger tax cuts concern you?
Sorry?
Would bigger tax cuts?
That's a hypothetical question. We'd look at that as we always have with tax cuts or government spending in the light of what else happens, the counterfactual of what doesn't happen, and where the economy is at that time. So I just can't answer generally.
Do you, or if you do, when do you take into account the opposition's tax cut policy when you're making your projections?
Our projections are based on government policy and policy at the time when it's clear that it's going to happen. So when it looks like it's got cabinet approval, and that's what we've always done. We would look at risks, broader risks out there if the occasion arises.
So if National was 20% ahead of the polls with 2 weeks to run and was projecting a big tax cut, you would actually take it into account in some way?
Well, that's a hypothetical we'll deal with.
But given the extent of the slowdown, does that make you feel much more comfortable about tax cuts than you perhaps otherwise would be?
Yes, I think that's fair to say. It's a softer economy, and that means that there's less domestic inflation pressures there in the system. And you will note that our non-tradeables inflation number is coming down. That's very important for us. That's one measure of inflation embedded in the system, and an important one for us. You will, of course, also notice that the CPI, when you strip out food and energy prices, is well within target zone. Actually, it's 1.6% at the minute, although it's about to go up somewhat. That's really an indicator of the fact that a lot of what we're facing is international price pressures coming in, and we've always said we'll focus on the medium term when faced with that.